Hello, fellow Robo Capitals. Hope you're well. So, we have big news that I want to go over. Actually, the news is within me connecting some dots for you guys about what the Fed's next move will likely be. Let's go right over to Fed Watch because we do have a Fed meeting coming up in about a month. And if we go over to Fed Watch, we can see that right now the probability is 75% the Fed will pause rates or keep rates where they are, right around 4.3%. A 25 roughly percent chance that they cut by 25 basis points. Now, what's really interesting is when I was setting up to do this video, the odds were actually different. When I was setting up to do this video, and this was a half hour ago, the odds were like 79%, very close to 80. So it seems like the market is front running this video. Maybe they've got a bug in my office somewhere that they're listening to me. I don't know. That's probably a topic for a separate video. But anyway, right now it's about 75% the Fed will stay right where they are. Now, if you listen to Jerome Powell come out yesterday, he's leaning towards, or at least based on his rhetoric, for what that's worth, he's leaning towards keeping rates where they are. But we have some dissent within the Federal Reserve. I want to get into that. I want to get into some data. And the punchline here is I think these odds are way off, way off. And I might be adjusting my personal portfolio as a result. So we'll try to, Josh, remind me to discuss that at the end of this video so I don't forget here. So let's start by going over a timeline, what's happening recently with the Federal Reserve. So Powell won't rule out. This is the latest thing. I don't know how they're coming to that conclusion, but I guess it's based on the prepared comments or remarks he made today about an hour ago. So let me get into this here. Below are Chair Powell prepared remarks to the House Committee on Financial Services. He's expected, okay, got it. Federal Reserve remains squarely focused on achieving our dual mandate. And I think one of these things that I read was talking about how Powell is saying that every single economist he knows is saying that we have to watch out for inflation. In fact, let's scroll down here. You guys will get a kick out of this. It wasn't this one. It was this one right here. Why has the Fed held rates steady despite a strong economy and strong economic data? In fact, I don't know that the person that wrote this headline actually read the couple paragraphs here. The headline really doesn't make any sense. But anyway, here's what I want to focus on. The second paragraph. But said Powell, is that proper English? But said Powell, the Fed opted not to make those cuts because all professional forecasters I know, all of them, expect meaningful increase in inflation over the course of the year due to tariff policy. So my advice, first and foremost, for Jerome Powell would be, dude, if all, like meaning 100% of the forecasters you know agree on something, you might want to get outside of that box, right? You might want to get outside of that echo chamber. I don't know if they're, I mean, as an example, let's just assume that I think the debt is going to continue to go up in the United States. I think most of us on this live stream or this video would be in that camp. But I'm very open. In fact, I would seek out people that have a different opinion on that, especially if 100% of the people that I talk to felt as though, or were saying, yes, 100% chance or close to it, the debt and the deficit increases in the United States. Okay, well, I would love to try to, especially I've had access to the resources Jerome Powell does at the Fed and his Rolodex. I would be seeking out people that I thought were smart, that had at least a little bit different view. Like maybe they think the debt's going to go up over the long run, but over the short run, maybe they think that the deficits as a percentage of GDP are going to come down as a result of GDP growth. I mean, that could be a good argument. I might be able to make that argument if I had to take that side of the debate. But it just shows you that the Fed, one of the main reasons they're probably offside so much, I think it boils down to two things. Number one, they live in this echo chamber of inaccuracy, and historically inaccurate. And also, they're bureaucrats at the end of the day. And their number one concern is not being right or wrong or keeping interest rates where they need to be or setting them where they need to be according to their econometric models. It's simply keeping their job. That's look, all these bureaucrats, that's why they're no good at forecasting, because forecasting often requires you to go against the grain. But that's not necessarily good for keeping your job. So that's why anything that you hear from the Federal Reserve is 99% of the time going to be consistent with mainstream economists. They're all going to speak from the exact same script. That's because they know that if they all say the exact same thing, if they all have the exact same opinion, if they all have the exact same prediction, then if they're wrong, well, no one could have known this. And no one could have known this because everyone is predicting the exact same thing that I'm predicting, at least everyone that's smart, that's in our echo chamber. And therefore, you have no reason to fire me because you'd have to fire everybody because everyone had the exact same view. You see how it works? But if everyone is way over here and you're a bureaucrat where you're now, see, this is why I really like listening to hedge fund managers as well, because they don't keep their job based on the consensus view. They keep their job based on performance, a profit and loss. And that, ladies and gentlemen, is truth serum, a truth serum I can respect. But going back to the bureaucrats, if they're all wrong, then everyone keeps their job. But if everyone is over here and you're that bureaucrat or that PhD at the Fed that has maybe a different view, well, you're not going to sit. There's no way that you're going to go against the grain or go against the herd, because if you are wrong, then you're definitely going to lose your job. So why not just always go along with the herd, and then you never, ever, ever have to worry about your job, and you'll likely continue to get promotions and make more money, not by being right, but by being consensus. So now they go into some other things here where, again, I don't really think the titles are matching up with what's going on here for whatever reason. Maybe they're using AI a little bit too much over there at Barron's. But the bottom line here is Powell is, for whatever reason, maybe he's telling Trump to F off or whatever it is. I think for Powell, I mean, unfortunately, I think he's going to come out on the losing end of this spat or whatever you want to call it with Trump, because I think when we look back over the next year, the Fed will likely drop more, especially more than Powell is leading on to right now. And then what's Trump going to say? He's going to say, told you so. Told you so, Powell. You're an idiot. You're a moron. You're stupid, which is literally what he's saying right now on Truth Social. But I think Trump is going to come out smelling like roses on this one. And then you have to ask, okay, when he hires the next Fed chair, is that in March or May of next year, he's obviously going to get a yes man or a yes woman. And then darn well that Trump, his narrow view of economics or macro is simply the country with the lowest interest rates has the biggest advantage, just like the country with the biggest tariffs has the biggest advantage. It's let's just say overly simplistic. But he looks at the ECB and sees them at 2%. It's like, wow, if they're at 2%, look at how much of an advantage they have over us, because we're at 4.3. So let's assume that the Fed does continue to cut or unexpectedly cut, which I think is my base case. We'll go into that here in a moment. So they unexpectedly cut, but then, you fast forward till Trump gets in his guy or gal, and it's a strong possibility the ECB is lower, And then they're going to cut as fast as they possibly can, regardless of what's going on in the U.S. economy, to try to get down lower than the ECB, because Trump thinks that's the best thing to do for the U.S. economy. So I'm not going to go into whether he's right or wrong. I think, again, that's overly simplistic, but I think that's, by what he said and his actions, I think that would be my base case as far as how he's going to handle the next Fed chair. And I don't think the next Fed chair, there's just almost a zero probability in my mind that they're going to do anything other than exactly what Trump wants. So now let's get into some of the recent people who, again, this isn't really a dissenting view. I wouldn't call it that. I wouldn't go that far. I think they're still within the range of acceptable consensus, going back to keeping their job. But they are expressing a slightly different view than Jerome Powell. So I just Googled it really quick here. You can see most recently, Michelle Bowman, if I'm pronouncing that right, said that she would back July interest rate cuts. And then you had Waller 5 days ago come out and say pretty much the exact same thing, that they would back interest rate cuts. So meaning the next Fed meeting, which is in, let's just call it, about a month, meaning that they would favor taking rates down by 25 basis points. Their argument is going to be, what they're going to use in their argument is going to be their dual mandate. It's going to be inflation and it's going to be unemployment. So I think what they're saying here is we see the probability or the odds of inflation coming down, of inflation not getting out of hand. And therefore, we want to err on the side of the labor market or supporting the labor market, because we think that the data is coming out weak and it will likely get weaker. So I think that's what they're saying here, which is kind of the opposite of what Jerome Powell is saying or insinuating. He is insinuating that the labor market is strong, resilient. We're at 4.2% unemployment, nothing to see here. And every single one of my friends or every single person I know that's a PhD economist is worried about inflation. Therefore, I should be more worried about inflation than I am about the unemployment rate spiking. But now let's go over some more recent data that I'm guessing probably impacted the Fed Watch that we pulled up at the beginning of this video. Remember how I was saying it's going, oh, and by the way, it's 35 days when the Fed meets. But remember how I was saying when I was getting ready for this video, it was right around 80%. And just in the last half hour, it went down to 75%. I don't know if this is real time here, if it's got a half hour lag on this Fed Watch. But my guess is it came down as a result of what we're going to talk about right now, which is sales of new homes tanked. That's not George Gammon's word. That's coming straight from the mainstream media and CNBC. Sales of new homes tanked in May, pushing supply up to a 3-year high. So remember this narrative that we've been dealing with, that there's no way housing prices can go down. It's not possible. Why? Because we're at a supply shortage. Well, maybe we were, but it seems like, and I'm sure we still are, in a lot of markets within the United States, but it seems as though that tide is starting to turn. So right here are the key talking points. Sales of new single-family home dropped 13.7%. Josh, I just remembered, while I'm saying this, can you pull up my Twitter feed, please? Because I want to go to that next.
Yep.
Thanks. And now let me get back to it right here. Okay. Home builders who reported quarterly earnings recently noted high rates cutting into affordability. Now, here's something I wanted to push back on, because this is, again, one of these narratives that you hear people talk about over and over and over and over and over again. Oh my gosh. Well, they kind of take any negative news in the housing market and just sweep it under the rug and just And the way they sweep it under the rug is just by saying, oh, well, mortgage rates, they're high. Unaffordability, mortgage rates. So if we could just get these mortgage rates down, then, oh my gosh, then the housing market would boom and the economy would rip. That's the main argument you hear. But what this implies is that just recently, over the last 3 months or 6 months, that mortgage rates are somehow way higher than they were a year ago or even 2 years ago. And this simply is not true. So what I did is I just actually pulled up 30-year fixed rate mortgage here. And this goes back a year, but we see that June 20th, 2024, mortgage rates were at 6.87. And as of June 18th, so we've got a bit of a lag here for some reason. You'd think if they have 900 PhDs at the Fed, that they could actually give us real-time data on the 30-year fixed rate mortgage when it's literally the most important interest rate for the entire U.S. economy. Like, okay, done with the rant. Anyway, they're right around 6.8%, maybe a little bit higher. But you can see a year ago, they're at 6.87%, almost 6.9. So have we had this just dramatic change in the last year? Not really. I mean, they're pretty much flat. So I don't know how you can argue that a decrease in home sales, I know this is just new home sales. I want to get over to the calendar to see if I can see existing. But it's not like you can sit here and say, oh my gosh, the reason why no one's buying a house is because mortgage rates are so high. Not really. I mean, they've had time to adjust, right? Meaning the buyers, and the prices would have had time to adjust or not go up to the degree to which they would have if the rates would have been a lot lower, if that's the argument. So I don't really buy this too much. And then I'd also point out that historically speaking, 6.8% is nothing. So if the economy was doing extremely well, I don't know, and especially the labor market, would people really balk at 6.8%? I don't think so. Now, you could argue that, well, prices are much higher. But again, they're slightly higher. But I think year over year, the data just came out the other day, and they're up like 3%. So it's not like they're up tremendously. So my point is, if over the last year, if the economy was really strong and resilient, you likely would have seen wage growth go up, real wages go up. And if real wages are going up due to a strong economy, then I don't think people are really going, or en masse, are going to struggle to pay a 6.8% interest rate if home prices, although they're historically high, I get it, but they're only 3% higher than they were a year ago. So I don't know why we should see. Now, it is true that I think that transactions would be very low. But again, what we're saying here is that transactions are way lower right now than they were a year ago when home prices were very similar and mortgage rates were very similar. So then the only other thing that you can conclude is the low transactions isn't necessarily a result of mortgage rates or home prices, but more so the labor market and the economy weakening. Josh, do you have that Twitter? Can you pull that up? There you got it. There you go. So let's scroll down, please. Or no. What are you doing, dude? You got to scroll down on my Twitter feed.
Yeah, my internet was just
scroll down to that tweet from Danielle.
Some issues.
All right. Well, while Josh is figuring that out, the bottom line here is I retweeted. There you go, right there. So great point. So here's Danielle, a good friend of mine. And I guess she just went on Charles Payne, who's a really good dude, by the way. I've been on his show a couple times. But she points out it took a long time for the increase in home prices, the increase in rents to show up in the CPI. But now it's actually going to be the largest drag on inflation going into the second half of 2025 and into 2026. So the reason I wanted, now let's just go back to the mortgage rates here for a moment. So the reason I wanted to bring that up is we're thinking about the Fed's dual mandate. And we're saying, okay, well, it's inflation, unemployment. So what do they prioritize moving forward? And right now, Powell's and every single person he knows, according to him, is saying that we're going to have hyperinflation over the next year because of tariffs. And what Danielle is pointing out is, whoa, let's pump the brakes here, Powell, because if the CPI is made up of, what is it, 33%? Home prices. And if we should assume over the next year, that will be a drag on the inflation rate as opposed to a boost to the inflation rate, then what's going to lead to all of this inflation? And again, let's assume that the tariffs do bump it a little bit for the stuff that you buy at Walmart or something like that. Oh, okay, fine, but that's not 33% of the basket. And you yourself admit that this is the metric you use for your target, right? The 2% target. So regardless, you can dispute that the metric is wrong, but then you would need to use a different metric, right? For targeting interest rates, or at least the Fed funds. So I think this is a great point, like I said, from Danielle, that we have to think through that you're going to, and I'm not saying that the CPI is going to be lower in a year than it is today, although that would be my base case. But what I am pointing out here is that if home prices do start to roll over slightly, and I'm not saying they crash, but even if they roll over a bit, let's say they come down in nominal terms by 3% over the next 12 months, that's going to be a huge headwind to inflation. It's going to be a tailwind to disinflation. Okay, now let's combine that with the fact that Trump wants rates not just lower, but way lower, like ECB low. And remember, they're at 2% right now. And let's combine that with the fact that he's going to get a guy or gal in there next year that's going to do exactly what he wants. Okay, so now you're starting to see maybe why I'm leaning a little bit more towards interest rates, at least Fed funds, going down and going down faster than the market is pricing in right now. But I'm not done yet. And that's kind of more long term. But over the short run, getting back to what's likely going to happen in the July meeting, let's actually look at the labor market, because everyone likes to talk about the headline unemployment rate being 4.2%. Okay, fantastic. But let's just do a quick thought experiment. Let's assume for a moment the labor force participation. Let's just assume we've got 350 million people in the United States, and I'll just throw out a number. We've got 200 million adults that are in the working age. Okay, so 200 million, that's our starting point. So now let's say out of the 200 million that 199 million leave the workforce, and we lose 199 million jobs, assuming that all 200 million people were working. So now in what was a labor force of 200 million people, what is an economy of 350 million people, now you only have 1 million people working. But the unemployment rate hasn't changed. Because remember, the unemployment rate is a formula that includes the amount of people that are in the workforce or choose to be in the workforce, and then the amount of people that are actually working, right? So it's not just because when we look at the unemployment rate, I think a lot of average Americans sit there and say 4.2 and say, oh, that's great. The labor market is strong and resilient, right? The jobs market is strong and resilient. Therefore, the U.S. economy is strong and resilient. because they think that 4.2% is strictly a representation of how many people are working. Therefore, how many people are able to consume, or how many people are actually creating the aggregate demand that goes into 70% of our GDP in the United States. But that's not true. That's oversimplifying things, because it's not just about the 4.2%. Like I said, it's about the number of jobs. That's what's important. The number of people that are actually working. Because again, if you had 10 people working in an economy of 350 million people, taking it to a wild extreme, but the unemployment rate was only 4.2% because no one's in the labor force, that's not a good economy. That's not a strong economy, you see. But again, most people, including the mainstream media, think that 4.2% is a direct representation of how many people are actually working in the United States, how many people have jobs. And that is an incorrect assumption. Let me tell you what I'm referring to. This is the last release from the BLS. And what I want you to focus on first and foremost is the civilian labor force right here. So last report, this was down 625,000. 625,000. So you have 625,000 fewer people in the labor force. Now, I don't care if they retired. The bottom line is they're not working anymore, so their consumption is likely going to go down dramatically, other than healthcare. So then we look at the number of actual people employed from month to month. And we can see in this last report, there was a decrease of almost 700,000 people working. So the amount of people employed in the United States was 700,000 lower than it was just the prior month. And somehow you've got Jerome Powell saying the coast is clear, the economy is booming, it's resilient, the labor market's strong because we have 4.2% unemployment. You see, this is the insanity. And this is another reason why I would suggest that Powell gets some new friends or starts talking to some different people than the 900 PhD that he surrounds himself in with this echo chamber that we call the Fed. Because maybe, just maybe, you would talk to someone, Jerome, that would look just 1 inch beneath the economic hood and say, you know what? Maybe we should just dissect this 4.2% number a little bit to see what goes into it. Because maybe, just maybe, we might come to a slightly different conclusion on the strength of the labor market. So, connecting all of the dots, we've got Trump that we know wants lower interest rates. We've got, and over the long term, we know that he's likely going to get them, and probably way lower than the market is expecting right now. We know that Jerome Powell is still leaning on the side of inflation, that's our biggest concern. But we also know that we've got some Fed governors coming out and saying, we have a little bit different view here. They're still in the consensus. Remember the Overton window. But they're saying, yeah, we get it. The labor market's definitely strong and resilient. And yeah, these tariffs could lead to consumer price inflation. But we're starting to lean on the side of the unemployment rate and the labor market deteriorating. And that should be our biggest concern, as opposed to consumer prices increasing or accelerating higher. That pertains to the short run. But I think what also pertains to July and connecting the dots is the fact that the labor market, if you look beneath the hood and actually do a little bit of thinking here and just don't fixate on the 4.2%, you see that it's not doing well. And it's not just the data from the BLS. I think that's why you're seeing what you're seeing in new home sales, that according to CNBC tanked. Why? It's probably not because of mortgage rates. I don't think it's because the home prices have gone up by 20% over the last year. I think it's more so due to the fact that people are just waving the white flag. The average Joe and Jane out there is tapped out. They don't see a strong labor market. They don't have a strong economy for 75% of Americans. In fact, I would argue 75% of Americans are probably in recession right now. And if you don't believe me, just look towards New York. If you guys didn't see that, the New York mayor race, the Democratic candidate is now, they're calling him a socialist. He's not a socialist. Absolutely not a socialist. The guy is a straight communist. He's a Marxist. I mean, if you look what he said, it's straight out of the Communist Manifesto. Well, why is that? Are we electing or potentially electing communists and Marxists in the United States because the labor market's strong, the economy is booming, and everyone's just getting rich? And everyone's purchasing power is increasing? Of course not. It's because the opposite is happening. And you can see by this guy's rhetoric, because this guy's rhetoric is that he's not just going to put rent controls on, he's going to freeze rent. So it's illegal to raise rent, 1 penny. And then he's going to bring in government-controlled or government-run supermarkets. So to keep food cheaper. Every single thing every one of his talking points is just, we're going to make things cheaper, 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 cheaper. What's he saying? We're going to increase your purchasing power because you're tapped out. And I know that you're tapped out. And your probability of you getting a better job or getting a raise to afford and put food on the table and a roof over your head is incredibly low. That's what people feel. That's what resonates with people right now, the average American. And therefore, that means we're leaning, or we should, as just prudent investors, we should be leaning on the side that sooner or later, probably very soon, the Fed is going to wake up and be a lot more concerned about the labor market and the economy than they are about consumer prices over the short run. And then over the long run, you've got the tailwind of Trump. So getting back to this Fed watch, I mean, am I sitting here predicting that they're going to drop by 25 basis points? I don't know. I would probably be 50-50 right now. But I'm definitely not 75-25. No way. No way. I'm closer to maybe the opposite. Maybe 75% that they are going to cut and 25% that they're not going to cut. So then you have to ask, what does this mean for your portfolio? Well, I'm going to make some changes, and I'm going to be going over that in a pretty thorough webinar this Friday on Rebel Capitalist Live within the forum. So if you want to check that out, if you want to check out the membership there, you can do a $1 weekly membership, or a $1 trial, I think it is, for 1 week. And that's at georgegammon.com/pro. And we're going to do this 11 a.m. Eastern time on Friday. And I want to do a deep dive into what I'm doing with my portfolio as a result of the conversation that I had with Chris McIntosh. And this is more pertaining to energy and commodities in this world of, quite frankly, chaos we live in right now, not just with the Middle East, but when you look at all of the geopolitical situations and what this means in terms of, or looking at through the lens of like a fourth turning or debt super cycles, if you want to use Ray Dalio's terms. And then I also want to combine that with what I think is likely going to happen with interest rates at the front end of the curve with the Fed. And I'm probably going to make some portfolio adjustments there as well. So I'm going to go over all of that in this webinar for Rebel Capitalist Pro members this Friday, 11 a.m. Eastern time. So if you want to participate, you want to check that out, go to georgegammon.com/pro. And if you can't make it at that time, don't worry, because we archive the webinar and it'll be up in the forum for you to watch at your convenience. All right, guys, enjoy the rest of your afternoon. As always, make sure you are standing up for freedom, liberty, free market, capitalism. We'll see you in the next video.